Welcome to the SIP, the Solstice Innovations podcast. In each episode, we chat with industry experts and innovators in insurance and insurtech. Join us for insights on trends, technologies, and the stories driving our industry forward. Let's sip on knowledge together at the SIP.
Hi, this is John Umstead with Solstice Innovations. On this episode of the SIP, our guest is Patrick Sullivan, VP of Industry Relations and Compliance at Assurant. This is a two-part episode of the SIP. In part one, we talk primarily about flood insurance. In part two, we expand the conversation to include risk management in general. Hope you enjoy. All right. Well, welcome, Patrick. Why don't we just jump right into things and have you introduce yourself? Tell us a little bit about your background, your journey, and the role that you play at Assurant.
Thanks so much, John. And thanks to you and the whole Solstice team for having me as a guest today. I really thank you for what you do for the flood insurance community. I enjoy these podcasts, and now I get to be a guest. This is great. So currently at Assurant, I'm the Vice President for Compliance and Industry Relations, supporting our lending businesses. So that's the insurance tracking and the lender-placed coverage, loss draft administration. But I also have responsibility for our private flood underwriting functions. So it's mostly the commercial product, not residential, but our private flood. I manage complaint response as well. So Department of Insurance and executive complaints. From an industry perspective, I'm on the board at the National Flood Association with you. I'm currently vice president. And then prior to that, prior to Assurant, I worked in credit policy and audit at Fannie Mae. And then actually I was on the very first Technical Mapping Advisory Council, like back in 1995 or 6 or something, and worked on loan servicing standards. And it began in banking. And so as we've discussed many times, I migrated into flood at some point or early on. And once you're in, you can't get out.
That's right. You're trapped. It is kind of a small community too. Everyone has worked with, for and against each other at some point in time. And yeah, once you're nobody, I've yet to come across somebody that said, "Hey, you know what would be a great career choice? Getting into flood insurance."
Yeah, I have yet to meet the person who was voted most likely to be a flood insurance expert in their high school class.
Yeah,
But
exactly.
that's where we end up.
Yep. All right. So let's talk about flood insurance a little bit. So the NFIP remains a dominant player of residential risk. So is it a given that, the mandatory purchase application still drives the bulk of purchases of flood insurance?
Great question. Short answer, yes, I think. The obligation to again, as it's written, it's if you have a federally backed mortgage, you have the obligation to get coverage. And I think that's probably the biggest driver of take-up rate for the NFIP, who again has the lion's share of the market, as you pointed out. And so I think when you drill down into that language, though, it's interesting because it was written as institutional protection. It wasn't necessarily written for consumers. It's a safety and soundness mechanism. And so the authors, congressional authors at the time, Flood Disaster Protection Act 68 established the flood insurance program. Mandatory purchase came in 73 as a way to increase take-up rate. But really, it was around, if you have that federally backed mortgage, we want to make sure that those institutions are protected from a counterparty standpoint in terms of this risk. And so it's never really meant to be a trigger for consumer purchase, but I think it does, because of how it's written and where it is and just how the law and the market has evolved. Yeah, I think it's the bigger trigger for take-up rate at this point. But, again, it's weird because if you look at from 2000, probably like 10-ish, NFIP, it's actually the policy counts declined. So we were at a high, they had about 5.5 million, and now they're at about 4.5 million. And the private market hasn't taken up all of those risks. And so you would assume that that's just attrition because the mortgage is no longer there, right? And so I think those statistics help support the narrative that, yeah, mandatory purchase is probably driving the bulk of the flood activity today.
So it's interesting to make that distinction between mandatory purchase versus in that institutional focus versus a customer focus. But what does the market need to do to shift to the consumer perspective, and would that improve the take-up rate?
I wish I knew what the market needed to do to shift consumer perspective. I think if we're going to shift consumer perspective is right. First we have to define it and sort of acknowledge what that perspective is currently. I mean, in the current state right now, it's the government tells me whether I do or do not need flood coverage, and it's a binary choice. I just saw an article in the Wall Street Journal a month and a half ago or so, and it was a feature on how much more frequent urban, even suburban and urban flooding is, and
Hmm.
riverine flooding and localized flooding. And they featured a woman in Chicago whose home had flooded 3 times in 30 years. So the 100-year flood zone is now, I tell you, they dropped to zero off, right? She's three floods, one flood every 10 years. And they interviewed her, and her quote was, "Well, I'm in a no flood zone. The government said so." Right? So it's like there's this perception out there that, well, the question of if I need flood insurance and how much to buy is a binary choice of yes, no, in, out, black, white. There's no gray, and the government is the arbitrator of that choice. And we as the broader industry, and maybe even state and congressional authors, legislative authors as well, we've conditioned generations of consumers to think this way. And so I think the shift that I'd like to see in consumer perspective is more along the lines of the way consumers choose their hazard coverage. That let's go out there and compare options, think about the risk. What's interesting, Florida, with Florida Citizens recently, they're in their third of 4 years of phasing in everybody who has a hazard policy with Citizens also has to now get standalone flood. They phased that in. And so that's changing the mindset as well. And look, floods can occur in a lot of places. I think the highest elevation in Florida is like 300 and something feet above sea level, right? So Florida, I think that the intent there was to eliminate wind and water disputes and just make sure that everybody's fully covered. Florida obviously is a cat state, flood prone state. So that's shifting consumer perspective somewhat as well. But I don't know. Just think, hopefully, as private carriers begin to increase their market share, they'll bring with them different perspective of measuring flood risk, and then the products will evolve as well. And so I think as we change what consumers are buying and how they're buying it, I think that will change perspectives also.
Yeah, let's lean into that a little bit. And before we do, just look back up, to the example that you gave with the lady in Chicago. Every time there's some sort of major event, you can bet on seeing some news coverage where, the field reporter is interviewing somebody who was a victim of the flood. And, they will say, "Hey, nobody told me that I was at risk, so I didn't have flood insurance." And it's like the consumer is waiting to be told, back to the point about mandatory purchase obligations, that they've got to have it. So, if that's still driving the majority of the market, and we said we've leaned into this, so let's lean in a little further. How should the industry think about voluntary coverage, not just for flood insurance, but as it also relates to hazard insurance in general and lender place protection, as sort of an interconnected system?
Yeah, and I'll just kind of try to build on your question built on the other question. Although this answer might build on my other answer. That insurance is on a continuum where you've got a preferred market, you've got this mass middle market that's more of a commodity, you've got non-standard market, fair plans, and down to lender-placed coverage. And so on that continuum, I think if we start to see the industry think about flood coverage the same way we think about hazard coverage on that continuum, that's gonna help bridge that flood gap. That's gonna help. They're all interconnected, right? You squeeze on one end of the balloon, it makes the other end of the balloon bigger. Obtaining a hazard policy is obviously more mainstream than a flood policy today. You think about the hazard market again. We talked about large market and large number of players. It's kind of more of a commodity, but more importantly, I think the financial literacy around the hazard process and hazard purchase process is at a much more mature level than it is for flood. And flood is still kind of obscure. We've got, it's the map. Nobody talks about any other risk management tool yet. We're starting to, again, as I talked about, like with these private flood carriers, as they're bringing their products and their solutions to the marketplace, they're also bringing their risk management tools, which go beyond the map, right? The federal map. And so, I think we'll see as the flood market evolves more towards what that hazard actually a hazard and auto. If you think about auto coverage, again, same type of thing. You go to buy hazard or auto today, and you're most likely on a comparative rater or a platform. And those do they exist for flood? Yeah, kind of, sort of. But it's a much smaller community. It's a much more narrow discussion, a much more narrow set of risk management tools. And so I think that it's the evolution of not just the products, but it's also the process, the connectivity of those players. As that evolves and becomes and looks more mainstream like hazard, then I think we'll see a better take-up rate. And an acknowledgement of the risk. Again, that homeowner's not measuring the risk the same way as they do for hazard.
That's exactly where I was just going to go with a little bit of a follow-on question is looking at that overall risk. We recently had Don Griffin from the APCIA on the podcast. He talked about what has been historically the annual National Flood Conference. Changing up in 2026, it will be flood, wind, and fire. So it's expanded to include those other hazards. Every once in a while, you hear political, rabble rousing about, should NFIP be expanded to include other risks? Do you think those things are sort of harbingers of things to come as we look at overall risk?
Yes, because again, that the markets are evolving, and again, as we see more competition in the private flood offerings, it's going to have to bring with it more of that link to more of the incorporate. They're going to want to be on the platform. They're going to want to be incorporated in the general risk discussion. That's going to increase the sale. That's the discussion that it's occurring at the time. And right now, flood is a do you need it, as opposed to should you have some. And the should you have some doesn't get prompted in the standalone, do you need to buy it? Yes, no decision. The should you have some discussion comes up if you're talking about hazard risk and wind and fire. And interesting, Nevada, at the beginning of the year, Nevada now carriers to exclude wildfire risk, and they're also allowing wildfire risk as a standalone endorsement on a homeowner's policy. And so I think we're not sure. I haven't gone through all the legislative notes yet, but we're pretty sure that the intent from from Nevada, from the department, was really to try to better isolate how much wildfire costs, what the wildfire component of the premium really is. But what's interesting is the mechanism for that is allowing wildfire to be excluded. And so you sort of have this specific wildfire endorsement. And so to your point, right, you're thinking about wildfire, you think about wind. Conceivably, you could do the same with a flood endorsement. So a standalone flood endorsement, what would that look like? And how would that be priced? And will we see that as one of the product offerings, and as the market evolves, will private carriers just say, oh, well, I could really just start using an endorsement for the flood risk? And so, yeah, I like that the conference is expanding, because again, as we're having that discussion, I think it's sort of this artificial barrier to have this conversation with the homeowner and say, well, let's just talk about your flood risk on Tuesday and your fire risk on Wednesday, and you won't talk about burglary on Thursday. No, you have the conversation.
Yeah, I'm looking forward to the conference for that very reason. It's going to be interesting to see how it plays out. Hey, another recent guest was Rick Padak, and with Rick, we talked about flood compliance and private flood solutions, how they interact with lending. So from your perspective, from Assurant's perspective, where do you see some of the biggest friction points today between lenders, insurers, and borrowers?
Yeah, and I always enjoy listening to Rick, but I wanted to tease you guys around. Okay, so how did you time having Rick as a guest right when the Pacific Northwest floods were occurring? I don't want to throw any conspiracy theories out there. So
We're just not good, Patrick.
your
We're just
timing
not
was
good.
good. No, well, it's really good timing if you think about it. Yeah, anytime you have touch, you have friction. I mean, that's the definition, right? And so, I mean, obviously, you have different levels of pressure. It's not always full 80 grit kind of friction, but it's still friction. You know, lenders, borrowers, insurers, right? They all have to connect. I'm not sure that any one handoff in that workflow is any more or less problematic than others. From the lending side, we see a lot of frustration with requests for paper during audits and exams when oftentimes that policy was bought, fulfilled, and evidenced all electronically. And so then you're trying to produce a piece of paper from a workflow that was never designed to support a single piece of paper. So a little bit of friction there on occasion. But most of the stakeholders are pretty well connected when you think about, I mean, FIP's got Pivot, private carriers have their platforms, loan servicing systems, policy administration systems among carriers. Loan servicing systems and policy administration systems are well heeled, very mature. Those things, they're probably the older of the systems in that touch point, but they don't in and of themselves create friction. And you've seen data aggregators step in and build bridges where needed. So yeah, we've got a little bit of friction because of the number of touch points, but I don't think any one of them is a deal breaker. None of them is a deal breaker.
So, this is anecdotally speaking, it it feels to me like, in the past, flood insurance was sort of this tucked away little thing, even within the carriers themselves. The flood insurance units tended to be kind of autonomous, not a lot of executive oversight or even vision into it. But like I say, anecdotally, it feels like with events like Katrina and Harvey, that began to change, and certainly over the last few years. It's changed a lot more. We see it in the media, we see it in social media, we hear politicians speak about it. We see CEOs being called to Congress or COOs being called to Congress to talk about it. So it does feel like flood insurance is becoming a bit more of a mainstream topic in those terms and how it's being discussed. And often that flood risk is sort of the entry point into that broader property risk management discussion. So how can insurers and lenders better use flood compliance moments to encourage stronger overall coverage and resilience?
Flood compliance moments, yeah. Um, we've had a few. Let me talk first, go back to the last question a little bit too as well. So the flood compliance piece um, r- really is driven from the mortgage. It's not. It's mostly applicable when you have the mortgage player in the game. And if you have just a borrower, policyholder, carrier discussion, it's different than if you have a carrier policyholder who has a mortgage and then the mortgagee and whatever and the touch point. Our friend Robert Coles is famous for saying having a mortgage doesn't change your flood risk. It might change your flood decision, but it doesn't change your flood risk. And so we should, from a compliance moment standpoint, a lot of those compliance moments are only because you had a mortgage. And so, when we think about how that impacts the risk decision, there's a couple of sayings in the legal sphere. I'm not a lawyer, but just that I'm going to turn one of them, and then we'll use the second. But there's the one: just because you can doesn't mean you should. I'm going to turn that around a little. Just because you don't have to doesn't mean you shouldn't. Just because you don't have to have flood coverage doesn't mean you shouldn't have some flood coverage. And maybe full coverage isn't mandated, but it doesn't mean you're free. You're free from the obligation. Great. That doesn't mean flood insurance is a bad idea or not needed. And so think about Houston, think about Harvey. That is the hallmark example for flooding, severe flooding, well outside the special flood hazard area. And so many of those properties, the vast majority of properties impacted in Harvey were not subject to mandatory. And so I think that's a compliance moment that warrants a pause and a debrief and a look at like, ooh, okay, this is a really good working example of I may be compliant. In other words, just because I don't have to doesn't mean I shouldn't. And so that's one that I'd like us as an industry to get better at. And as lenders are increasing, like think about it, there's like lenders are increasing their knowledge of their portfolio risk. OCC came out with guidance. There was a administrative memo, CFPB as well, relative to the response to climate changes, and this was under the Biden administration. And so that guidance is still out there. And so lenders now have a greater awareness, well, they're supposed to have a greater awareness of their portfolio risk due to exposure to climate. And so whether that's, I mean, that underinsurance issue or simply the increased credit risk relative to how disasters can impact delinquency. And right now, there's a statistic that FHFA just put out, about 45% of forbearance is related to disaster. Now, that could be because the borrower's employment has been impacted by the disaster. It doesn't mean each of those forbearance instances is specific to that individual borrower's property. But again, climate risk in general. And so now that the lenders are having that greater insight, does that change plaintiff argument around advisory of should I have been told? And then if we look at the second saying, the ignorance of the law is no excuse. Love that one, right? And you hear that from attorneys. Actually, you probably hear that more from judges than attorneys, but you hear that. And when we think about flood, we apply the sort of, we think NFIP is the gold standard. Private flood's going to be state regulated. And so we have to make sure that we don't apply the federal standard. The NFIP is really the anomaly here in the mainstream, and what we have to do in terms of consumer disclosure, in terms of that conversation, in terms of what the fiduciary risk of an agent is. When we think about the obligations that exist from the private flood space, they may be a little different than, as we've talked about, that mandatory purchase obligation is how flood has traditionally been communicated. And we may need to shift that mindset somewhat from the, again, ignorance of the law is no excuse. And so I think that will help us focus on resiliency and increasing the coverage.
As kind of the state law need not apply when you're talking federal program. That concludes part one of this two-part episode of The SIP with Patrick Sullivan of Assurant.